Hey everybody, Jeff Dorman, Chief Investment Officer at Arca, back for another edition of That's Our Two Satoshis Live. For those who don't know, we put out a weekly blog every week on our website, ar.ca, where you can find our market thoughts. And then we get to bring in one of the esteemed colleagues of mine to talk about what we're doing. So today I bring you David Nage, who is the principal of our venture fund Endeavor. David, how you doing?
Feeling very esteemed today, Jeff. Thank you.
You look esteemed with the bookshelf behind you and everything. You look like you got a fresh haircut. Everything looks great, man. I'm happy to
Thank
have you
you.
on the. So David is probably no stranger to most of you. He's been around the markets for a long time. Actually hosts his own podcast. Usually I'm his guest, but this is a reversal here. But David got to write this week's That's Our Two Satoshis. If you haven't had a chance to read it, I suggest you do. It's really well done. Basically, what we're trying to get to is what the hell is going on between the public markets and the private markets, because the public markets, meaning all the liquid digital assets, as well as even if you go into equities and other liquid assets, just getting obliterated every day right now. But there is a huge pile of money chasing private deals right now. So, David, you invest in the public markets in your career. You've invested in the private markets. Obviously, now at Arca, you are more focused on the privates.
Yep.
What's going on? What's causing this? What should we be thinking about it?
Yeah, I think what's going on right now is there's a bifurcation, as you alluded to. There is obviously what's happened in the liquid markets and what's happening in the private markets. The private markets, especially in venture, is much more elongated, durational. It's what's going to happen not necessarily in the next 5 days, but what's going to happen in the next 5 years, what's going to happen in the next 10 years. What are the trends going to be then? And are we going to be able to find founders and solutions that are meeting those dynamic needs at that point in time? Versus now, obviously, when we're dealing with the public markets, not just in digital assets, but across the board in equities and also credit, we're dealing with geopolitical shocks left and right. We've had a global pandemic for the last 2 years that has affected supply chains all over the place. We've had, obviously, now the Ukrainian war, where we have issues abound, and also now affecting geopolitical and not only economic issues like oil getting to about $135 a barrel. That's all going to have an effect. And we're starting to see now with inflationary issues, not only because of our own issues here in the United States, but because of the cost of goods like wheat that are now going parabolically higher. So all of that is in today's time. And whereas in private markets and venture, obviously, where we invest in Endeavor, is focused on not necessarily what's happening now, but what's happening in the next 5, 10, 15 years. What are those cycles going to look like? What are those trends going to be like? And so for us, what we're seeing in the venture side of things, we're seeing a few things. One, we did some analysis for our two Satoshis, which everyone can read. We looked at what's happened this time last year and what's happened now over the last month from February to March. This time last year, in terms of venture, the typical checks were typically about $2 million in seed rounds, meaning that a seed round, a founder raising in DeFi, NFTs, Web3 was raising about $2 million at about a $10 or so million valuation, kind of post of that money. What we're seeing now today is that we're seeing roughly about $4 million coming into the same rounds. And we're seeing those valuations going past $20 million pre-money valuation. So we're seeing a doubling of that. We're seeing an increase. And so why is that? We think there's a few different reasons behind that. One, the quality of founder coming into the space is better than it ever has been before. And why is that? Well, that's also relationship to the public markets. We've had big wins like Axie Infinity, which we've obviously talked about a lot as a firm and publicly, where we had 38,000 daily active users in April of 2021. And by the end of the year, we had about 3 million users. That became something that was a shot across the bow, where founders in gaming saw that and said, well, this is a place that's actually starting to take some notice, that's taking some heat. There's actually some growth here. It's not just all kind of speculation. And so that definitely was something that we're seeing is in founder quality. And that's not just in gaming, but that's also in Web3. We're seeing founders that have been at Google and Facebook that are addressing things like identity. As a team, we're actually talking to a bunch of founders that came from Google and Facebook, of all places in the world, that have obviously been at the forefront of identity, and we're talking to them now. And so the founder quality at this point in time is just so rich. And the problems that they're trying to address are expansive. In addition,
let me cut you off for 1 second here. Let me
Sure.
ask you this. So it's clear that the public markets are looking, 3 months out, if not 3 days out, whereas the
That's right.
private markets are looking, 3 years out or longer, right? So
Yep.
basically, an obvious statement would be those who are investing in a, locked up, longer term kind of investment are not as concerned about the day to day
Hmm.
because, the ultimate success or failure of your investment is not going to be dictated by a 2 or 3 month event in terms of war or a price shock with oil. That
Right.
I think is intuitive. That makes sense. I
Yep.
guess what I don't understand though is why would the private investors not be lowering their bids? Why not try to get everything for 50% off right now when the rest of the market is? Like, where is that excess pressure or demand coming from that
Yep.
is allowing early stage deals to still get incredible prices when those same or similar type companies are getting half off sales in
Yeah,
the
we're
public
gonna have a
market?
little fun with this, Jeff. I don't know if you, when you were back here in New York, if you ever went to a Knicks game at MSG at Madison
I
Square
have.
Garden. Yeah, yeah, they could be the worst team in the world, and they have been. Sorry if they're Knicks fans. I am too a Knicks fan, but I pay for this. They're the worst team in the world right now. They can't win a game to save their life, and yet the tickets there are $1,000, $2,000, $3,000, a pop. Why? Because there's somebody else who's willing to pay that because they want to go to see the Knicks in the front row. That's just the case that it is right now with venture. Is that someone else on the other line is willing to pay a higher price. And what we've seen with traditional venture over the years that I've been watching the space is that there is just a wall. We always call it a wall of capital. Back 10 some odd years ago, less than 10 years ago, you had SoftBank that came out with their vision funds, and those vision funds were $100 billion earmarked for venture. And so I always talk about this time and time again, but it was really kind of a big moment for me to see what was happening in the market. Is that of all things, basically, um, one of the biggest technology companies in the world, Square, was about to go public, and they had a private valuation of about $6.5 to $7 billion. Fidelity cut that in half right before the IPO at about $3 billion. It came in at a late round and cut it to about $3 billion. Everyone and their mother's grandmother said, okay, this is the time when the valuations are going to reset. Obviously, valuations are getting too high. Things just don't make any sense anymore. Valuations are going to reset. Did valuations reset? No. Why? Because someone else wants to buy the ticket, to the Knicks game and sit it front court, and they're willing to pay a higher price for it than you and I. That's what's happening here in venture. Is that there is a wall of capital that has entered into this space, and of no time ever before between you and I's kind of existence in digital assets has this ever been more true. Is that we have seen more multi-billion-dollar fund entries in digital assets earmarked for venture in the last 6 months than we've ever seen before. FTX, Paradigm, Electric Capital, you name it, across the board are raising billion-dollar plus funds that are earmarked for this space on the venture side. And so what's happening is that, these rounds are coming about. You have a founder who has experience. You have a founder who's building in Web3. You have a founder that's building in gaming. And lo and behold, someone else wants to pay a higher price for that front court seat than you and I, and they're getting into those rounds. So it is a competitive space. But here's the thing, and I know you're going to talk about this because you're like, well, that just, that sounds terrible. But here's the thing. So yes, there is a wall of capital, but founders, and I have to say this because we have a lot of evidence on this because we talk to them every single day. Founders are getting very, very specific. They don't just want capital. They know that capital doesn't help them per se. They want resource. They want network. They want things like marketing, like what we do on base layer, what we do here as a firm, and trying to help the investors know about what they're building. They don't just want the capital. They don't want someone just to wire a USDC or write them a check and let them build. They really want the cooperative. They want that help. So yes, there's a lot of capital out there. And yes, founders know that there's a lot of capital out there, so they can jack the valuations higher than they have been before.
Okay, so safe to say, as long as the digital asset market continues on the trajectory that it has, where when you're right, you're very right, and the returns are in the 50 to 500x range, spending 2x too much on a private deal probably doesn't matter, right? It doesn't really eat into your returns too much. The question is, what happens when the end buyer for the private, let's say you buy a private round and 3-5 years later it's doing well. What happens when the end buyer isn't there, right? Because if you look at the equity market right now, 10-15 years ago, companies would not stay private very long, right? They would immediately try to go public as fast as they could. and a majority of the gains would then be received by the public investors, right? Your IPO investors, your retail investors, et cetera. In the last few years, that's shifted, right? Companies, for a lot of reasons, right? Some legal and regulatory, some financial burden, some just because of the wall of money that was in the private markets, but a lot of in the traditional equity market were delaying going public, if at all, right? Yep. Which meant that the private investors were reaping most of the gains, and by the time it actually went to the IPO and to the public markets, it actually declined, right? You don't have to go far on Twitter or anywhere to see a chart of just the precipitous decline of 2021 IPOs, right? From your Coinbases to your Robinhoods, to you name it. What happens in the digital asset market when that same thing happens, right? Which is all this money is being raised in the venture funds, all this money is being poured into private rounds, but there's just the retail investor isn't there in the public markets, or there aren't enough established, long only, mutual fund like funds in the digital asset market. Like, how long can a dichotomy like this last before the end public buyer is just like, no, I'm not going to take you out of this position, and therefore either private valuations have to reset lower, or to hold it private is longer, or ultimately there has to be some effort by the private investors to beef up the public markets as well.
Yeah. A few different things there. One, I'm very happy that we invest earlier in the maturation of these companies. Obviously, we're in the seed round, and maybe we do a few A's here and there, so we're real early. So our multiple invested capital potential is much higher than someone who's doing a Series H plus. And so those are things that we obviously are cognizant of, is that once you get, more late stage, you get to a Series C or a Series D, or as I said, a Series H plus, and some of these that I've had over the last few years, it starts to become obviously a point of issue that you're talking about, that, what is the end state here? Where do you go? Do you go public? Can you go public at the same valuation that you had in your private valuations? If you were valued at $100 billion in the private rounds, and you try to IPO, are you going to take a significant haircut and come in at like 50 billion valuation or less? Those are issues obviously that are abound. And so again, one of the reasons why we have, specifically carved out for early stage and seed and Series A is that our valuations are typically in the 30 to 40 to $50 million range. And so God bless us if we get to $50 billion valuation on our deals, because our investors are going to be thrilled. So, all told, I'd say what we're going to start seeing is we're going to probably start seeing more M&A activity as things stay private longer. I have been saying this for years, is that I think M&A activity in digital assets is going to be, really rife for activity over the next few years. You're starting to see that. You've seen that already with multiple acquisitions. Specifically Coinbase has made a lot of acquisitions. Kraken's made a lot of acquisitions. A lot of the CeFi players have made acquisitions, especially in the DeFi world. So acquisitions are definitely going to be there, and I think that's not going to end anytime soon. And those companies have fairly big coffers of capital to be able to pay for that. In terms of going public, or kind of the exit strategy of going public, some of these obviously are ones that are going to be deemed going public. They're more SaaS-based analytical type of platforms, the Coinmetrics of the world, and some of the other kind of tax and accounting platforms of the world. That's kind of, one of their strategies is going public. Maybe the public markets rebound in the next few years. Many of them are raising enough capital where they can, kind of weather the next 2 to 3 years of public market turbulence. As I said again, though, a lot of them that are solving problems, especially tax and accounting. We have a company in our portfolio that deals with that called Bitwave. We think that is, something where a big, kind of tax and accounting firm on the legacy side is going to acknowledge that they have massive gaps and they don't have the ability to service this new industry, and they're going to need to, obviously do some acquisitions there. I definitely think that, in terms of the more kind of digital asset natives out there, these are the ones where you typically have some sort of a token associated with that. Now, this is obviously more, in a lot of your world where you're dealing with live, liquid digital assets. Yes, this is also something that we're very cognizant of, is that the current market today, obviously since around December of last year, has been fairly compressed. We also are seeing, some of the things in terms of the IDO, the initial DEX offering that was fairly popular all of last year. We're starting to see the IDO is getting pushed out until June, July, August of this year, because, obviously the market is in imbalance. As you said in the beginning onset, it's not very pretty out there right now. So I'd say, for, again, the venture side of this asset class, you probably will see M&A activity really picking up a lot over the next, few months and into next year. I also think that as we continue going on, we will start to see a little bit more, valuation cut possibly. If you have later stage companies that are raising, at some point you're going to have to see some sort of a cut. If it's a, as I said, an H plus series, at $75 billion, maybe the market doesn't necessarily carry that. But again, I think you're definitely hitting on something there. That's something that we're watching constantly.
Yeah, well, I think I'm a believer that private and public markets are not disconnected at all. They are tied to the hip. They just have different time horizons, and inevitably, this right. Either the public markets are incredibly cheap right now and totally mispriced, or the private markets are overvalued. And I think anyone who's in the digital asset market as long as we have, and I'm sure there's tons of people out there even longer than us, we still believe that the return potential is massive here. So the private markets, while looking frothy relative to public right now, is probably right? Because they're able to look through the noise right now and ignore it and just look for good deals. Whereas the public markets are on pins and needles on, every tick from the NASDAQ and every tick from the VIX and every headline from Russia and Ukraine. So I would be, as a betting man here, I think the private markets are probably right. And the public markets are massively mispriced right now. But, we got a lot of work to do to close that gap. This has been probably the biggest spread we've ever seen in terms of private and public. We saw something similar in May and June. Markets started to come in, and that was one signal that it was time to buy the public markets because they were mispriced. So we'll see if that's true again or not here. But I think inevitably, I think the takeaway for me is it's a really good time to be a founder and building a cool project in this space because there's a lot of money interested in investing, and there's a lot of good firms out there with the resources to help you succeed. And there's a good chance that both sides win, in the next 3 to 10 years.
Yeah, I agree. And yeah, I would say, one of the things that, I think is really, fairly interesting is that we get to write the narrative a lot here about what's going to happen in the future. And in terms of DeFi, one of the things that we're really excited about, and I think is a narrative that's, really driving a lot of interest, is that, there's this new idea of credit and credit reputation and credit scoring. Obviously we're dealing with a crisis right now in the middle, obviously of the European nations out there. People need identities, people need credit, people have left everything that they had. And there's this idea out there that's been germinating in DeFi that you can use activities, whether they're real world activities or they're digital asset native activities, and build a credit score, build an identity, build a reputation. These are things that are not just, for today, but they're for the next, generation to come. And in terms of gaming, as that we've been focused, and I'm obviously emphatic about gaming, is that these are not just, and I've learned this the hard way, this is not just games. These are social networks where people get to connect with each other. They get to form community with each other. And in the places that we're starting to really manifest and invest, these countries that, in parts of the world that we invest in and related to play-to-earn games and guilds, are dealing with massive issues with inflation and unemployment due to COVID and also obviously government policy. And so these people need some sort of a kind of, assistance. They need a side hustle. And you're actually starting to see that manifest with gaming and guilds, that they actually have the ability to make a little bit extra money so they can pay for food and groceries and rent and clothing. These are things that are actually, we've talked about this as a firm, kind of, the ESG, kind of flipping that to the GSE narrative, is that there's a lot here that's happening in digital assets that can help people around the world, especially when we're dealing with obviously a pandemic and hopefully an endemic, when we're dealing with obviously a massive crisis with Russia and Ukraine and the surrounding regions. There's a lot here that's been building over the last few years that, from the public markets perspective that we have obviously supported, but now from a venture perspective, we're really able to support founders who are building things that are very meaningful. And so irregardless of what's happening today in the markets and what's happening tomorrow in the markets, the ability for us to be able to invest in what's going to happen for our future, I think is something that every day I wake up and this is the only time in my life, in my professional career, that I wake up every morning, I'm fired up to go. And so anyone else who's in this space, I hope that feels the same way.
Well, I know I do, and I think that's a good place to end it. So David Nage, thank you for joining us. For those listening, you can read the entire blog at ar.ca/blog. pretty good insights there on what's happening in the private markets, and certainly more to come from David and his team over time here. So David, thanks for joining us, and we'll see you guys next week.
Thank you, sir.